Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Hey, Daniel, the other day I went and bought sandwiches for our team, and it was crazy. It hadn't been that long, maybe a month or two since the last time I was in, and the prices for these sandwiches had increased like 30 or 40% in just like a month or two.
Yeah, the price inflation has been ridiculous. And you know what I've been wondering is retirees, how have they compensated for that? Do they have more spending power? Like, cut out Social Security. Do they have more spending power today than 2 years ago? Right? And you know what? I think we should talk about that. What are people's plans to protect themselves from inflation? I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is inflation. What's your strategy? Daniel, I think that's a great thing. When you're talking about inflation, there's a couple of different angles, right, that we can talk about. One, and people don't think of it because inflation typically gets lumped into one category, right? Inflation is inflation. Well, no, it's not, right? There's price inflation, and then there's monetary inflation, right? So why don't you help us understand the difference between those two to start off right here?
Well, first of all, it's good to see you. It's good to see you, Triple A. It's been a while. I mean, it's not a while since I've seen you in person, but it's a while since I've seen you on the show, right? We've both been doing some traveling and some different things, so it's good to get back with you on the show.
It's been crazy.
Yeah. But yeah, I think inflation's a really important thing to talk about because, again, I'm going to ask that question of, if you're retired, how much more spending power do you have than 2 years ago? Because CPI, you can say whatever you want. But when you go to the grocery store, you go to a restaurant, that's real inflation. Things you spend money on. That's what real price inflation is. How much money it costs to get the goods and services that you need.
How much do those sandwiches cost? Right.
And so if you travel a lot and that's up, or if you go to restaurants a lot and that's up, or you like fresh, good produce and that's up, or gas, right? So these are kinds of things that are price inflation. How much does it cost you to buy the same good or service?
Okay. So price inflation.
Monetary inflation is when the money supply is increasing. And this happened a lot between 2008 and 2019. But we didn't really see a lot of price inflation. People didn't really notice their groceries going up very much over that period of time. People didn't really notice gas going up. Yes, there were spikes here and there.
Right.
But, when Trump was in office, it was cheaper than when Obama was in office.
Right.
So it actually was deflationary through that period if you're talking about gasoline, right?
Right.
So there wasn't a lot of price inflation, but there was a lot of money creation. Why didn't we see it in prices? Well, because it was all backdoor stuff. It was all behind the system, right? It was quantitative easing, and it was purchasing this, and it was the Fed buying this and doing this. They didn't go into people's pockets. Why we saw the huge inflation between 2020 and 2023 is because that money went into people's pockets. Right. And when people have more money, what do?
Spend it.
They spend it. And then we had supply chain issues. So what happened? We had more money chasing fewer goods. Right. Well, now people are running out of money. They're running out of spending power on their credit cards.
Yeah.
And companies are finally catching up with inventories.
Right.
And so now there's less money and more goods. And so it will be interesting to see. I don't particularly think that there will be a lot of price inflation. I think we're more in deflation area over these next few years.
Okay. So monetary inflation, government printing more money, putting more money out there. Price inflation, where the prices of things are increasing. So two different kinds of inflation, but still inflation. And you need to have a strategy for how to deal with that. And
you want to protect yourself from both, right?
Right. Right.
And that's why that question is so important of do you have more spend as a retiree? Do you have more spending power? Do you have more money coming into your bank account so you can compensate for these, or are you just spending less money? Because
Right.
if you over the last 2 years don't have more spendable income from your investments, whoever's managing your money, you, your advisor, whatever, they failed.
Right.
And you need to think about that, because
Right.
now we're getting ready for the next type of inflation. And if they failed on the last 2 years, are they going to fail on the next 2 years?
Right. Right. It's a serious question. And these two kinds of inflation affect retirees differently, right? And we're going to have to talk about that in a minute. But the key in when you're putting together an inflation strategy is you need to know how much you need to retire. And if you're not retired, well, this is a key piece of your situation. And then there's what you need to retire and what you want to retire. Those are two different things. And that's another topic for another time. But how much do I need to retire? And we put together a couple page paper that's glad that, that you can use to understand and to work out how much you need to retire so you can have a perspective. Because once you know how much you need to retire, then you know how much you need to be able to stay up with inflation and what you need to be able to get on returns. And one of the big keys is double digit returns in regard to that. And that, if you do things properly, you can get that. So anyway, you can have this paper by calling us at 800-725-7616, 800-725-7616. You can contact us on the web as well at Agemy. Our last name is spelled Agemy. The two words Agemy, Agemy. My son Daniel and I are here to educate you, because people don't know what people don't know. So financial strategies with the Andrew and Daniel Agemy to be able to help you. And so we want to educate you with this paper, 800-725-7616 for your free copy. Now, Daniel, this inflation that we're talking about, these two kinds, for people who are retired and people who have been retired for a while, whatnot, maybe the price inflation aspect is not so important to them at this point in time. It may come more into play later in the future with healthcare inflation and everything that's going on for that. But right now, as far as that goes, that may not be. But you never know at what point it's going to kick.
Well, you mean monetary inflation when you say that?
Well, the price inflation is not as important right now. The monetary inflation is important right now, is my understanding. Am I on the right page with that?
Price inflation, right, is what we've been going through the last few years. When people go buy sandwiches, right, then some more money. But yes, those effects, the money's wearing out. Yes, exactly. The money's wearing off. All that people chasing the goods is wearing off, right? Credit limits are running out. There are some still things like all these union deals where people are getting, UPS just gave all their people more money. So there still is some things where people are getting more wages, more to spend. But yeah, supply chains have caught up, all these kinds of things. So that is less of a factor right now, unless you're still behind. You're still behind and you haven't caught up yet as far as your spending power. Yes, I misunderstood what you were saying.
But for the people who have been retired, the monetary inflation is a huge deal. People who are getting ready to retire, maybe 5 or 10 years within retirement, or just getting ready to retire now, and people maybe 50, 55, 60 years old, 65 years old, getting ready to retire, both of them are important. The price inflation, because they got a lot of years ahead of them to where they're going to need more money to live the way that they want to live in retirement, plus the monetary inflation coming in where you have the increased money supply will be an adverse effect upon their retirement as well. So these things are important. The monetary inflation is huge for both groups. I'm talking about younger retirees. I'm talking about older retirees. But the younger retirees have both the price inflation as well as monetary inflation. The elder ones more monetary right now, but in the future, the price inflation will come back for them in the future as well. Right? Am I on the right page with that?
Yeah, exactly. That's exactly right. So
Okay.
if you want an inheritance, if you want this inheritance to go to your grandchildren's grandchildren, right?
Right.
For that dollar amount to be worth anything to your grandchildren's grandchildren, and you expect governments to continue to create money like they have, that number has to be much bigger than it is today,
Right.
right? That you're passing on, because without any crises or depressions or recessions, the U.S. has been kind of creating an increase of money supply by about 7% annually.
Right.
Now, we haven't seen that in prices because it's all, like I said, smoke and mirrors behind this stuff. But when they start giving money to people and they start spending it, that's where we see it. Yes.
Yeah. Yeah. And so, the strategy that people have for inflation is huge. I mean, there may be people that are wanting to pass on generational wealth, right? Well, you have to have a strategy. You have to have more than just an idea, a goal. You have to have a strategy for how you're going to be able to get that. And that takes work, right? The typical answer of financial people are, well, you got to invest in the market to stay up with inflation, which we know is not true. That is not true. That's a fallacy, along with so many other fallacies that come out of Wall Street, right? And for retirees especially. And we're going to talk about that, but we're going to have to take a break first. And before we go to break, what I want to do is offer you and our listening audience this book that we have from More Life Than Money, rather. More Money. Let's try that again. I think it should be called More Money Than Life, but it's More Life Than Money by my friend Anthony Siccaro, and How Not to Outlive Your Savings. Anthony's done a great job of writing this book, which all the different things that you don't know about. And it's a great, easy read, good read. I highly recommend it. It's yours for free to the next first-time 5 callers at 800-725-7616. 800-725-7616. To get your free copy. The next 5 first-time callers. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
Daniel, it's so cool. The other day I was meeting with somebody and we're doing a review, and we're looking at, their 2 values. The bottom lines on their summary that we gave them. One is, how much money that they have. The other is how much retirement income they have. And I was so excited that this particular client's retirement income in the past year is up 30%. 30%. That's like phenomenal. I love that. And, typically, as you well know, this is what we're doing. Our clients are seeing an average of double-digit inflation over the past 2 years, and keeping up with that and increasing their retirement income. So it's just a great, great thing. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about inflation. What's your strategy? And in order to have a strategy, you need to understand the 2 different types of inflation. One may or may not be behind us, right? When that's the price inflation. It looks like there is a lot of leading indicators saying that is going into disinflation. It already has been in disinflation and maybe going into deflation. That doesn't mean prices are coming down. So you still need that portfolio increase that you're talking about, or income increase, right? I don't want to get a portfolio because it doesn't necessarily mean the portfolio goes up in value.
Right.
It will eventually because the compounding, but it doesn't mean like today the portfolio values. However, what it does mean though is that your spending power went up, and the story you're telling, you're talking about a 30% increase. So like that's you go to work, you're making $100,000 a year, and you walk in and your boss says, "I'd like to give you a $30,000 raise."
That's
who's like, no, increase. Thank you.
Right. But for retirement, right? That's the goal. How I don't know how many, there's going to be very few financial professionals out there that can tout that, especially over the past 2 years, that their client's income has increased double digit on average over the past 2 years. So that's just a beautiful thing. And, Daniel, I just like to say when you're talking about this, you mentioned disinflation and deflation. And for our audience, I know it's hard for me to get my head around these things a little bit. So I'm going to just try to, do this, right? That disinflation is where it's not where the prices are not growing as fast, right? It's less fast. Gasoline has not really, well, it increases, then it decreases and increases. So it's not growing as fast as it did, right? Because it had jumped up 50% or 100% or something like a short time. So there's kind of like disinflation, I'm thinking there. But then deflation is when prices, when the costs, where there's actually a negative inflation, right? Where things are going down. Typically, things are not going to go down in price, right? Overall, right? They're going to be somewhere in the same range, kind of like the way gas is. Gas will go up to, in Connecticut, maybe, closer to $4 a gallon, then back down to $3.50, $3.25, somewhere in that fair area. And, so they're not going to go down anytime soon to $2 a gallon, right? But, it has that fluctuation there. So, but the key is what your money is purchasing and what you can purchase with your money from that angle.
Exactly. And so, governments are terrified of deflation. I know that like Jerome Powell gets out there and says, we don't want inflation, we're going to keep it at, they're terrified of deflation. Why are they terrified of deflation? People don't really like deflation either, because that means their pays could come down.
Yeah.
But why would you care if your pay came down if your spending power went up?
Right.
So if things got so much cheaper or got to free, why would you care if your pay came down a little bit? Because
more is better. And if you're going backwards, it's not as much, right? So more, we can have this mentality that more is better, right? And it doesn't matter the underlying facet and how it's calculated. If you have less, that you can actually buy more with that, because people don't see that. They see, oh, my paycheck is going down or whatever. So nobody likes that.
Right. So what is an entrepreneur's job? To give us a better service for cheaper, right? So what does technology do? How much does this, people are listening to this show, how much is this costing them? Especially if they're listening to the podcast, how much is it costing them?
Nothing.
It's absolutely free.
Right.
Right?
Right.
If this was 20 years ago, you'd have to go to some class. You'd have to get sign up for a college class to get this information, right? Or you'd have to go to an event that you pay money to go to get the education.
It would cost time to drive there and all that kind of stuff as well. Yeah.
Yeah. But technology made that free, right? A calculator. Right. Think about a calculator. You used to have to go buy a calculator.
Yeah.
And they may not even be cheap.
Right.
And now an entrepreneur made that free on your phone. Your phone has a calculator for free. You wouldn't even consider paying money for a calculator, right?
Right.
So we live in a deflationary world because of technology and because of these things. But we're scared of deflation because of the debt, because we have so much debt. And if the cost of if incomes come down, if GDP went down, the debt would never be able to be paid off. And that's where we start talking about monetary inflation.
Right. Okay. All right. Well, this is good stuff, Daniel. And what I want to do to you and our listening audience is let you know that you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And in order to help you to know what you don't know, we put together a piece called How Much Do I Need to Retire On? That's not, there's two numbers when you're talking about retiring. One is how much you need to retire, and the other is what you want to retire. But this piece will help you be able to put some of that together. And then, if you want to go further than that, we can also help you and have a conversation with you about that if you're so inclined. But you can have this piece for free by calling us at 800-725-7616, 800-725-7616, or go to our website, agemy.com, and you can put in a comment there or check out all the other podcasts and videos and whatnot that we have there for educational purposes so that you can know what you don't know. Today, we're talking about inflation. What's your strategy? And inflation is a key part of life. And we want to make sure that you're ahead of inflation. The consumer price index, kind of interesting when you're talking about that, because a lot of people, look at that for what inflation is, right? And so that's one number. But then people are always saying to me, yeah, but that number says 3%, but the grocery store says it's more like 20% or whatever, right? And then the other factor is, a lot of people don't know this, Daniel, is that back in the 90s, early 90s, they changed the CPI, and they changed the standard by which they gauged the CPI. So if you looked at today's CPI, it's totally different than if you went to shadowstats.com and saw what the original pre-1991 CPI was like, and it would be tremendously higher than that. So, but what we're talking about is inflation in general. We're not talking consumer price index. We're talking about inflation in general, both the pricing aspect that maybe is not so important at this point because things have jumped up, and they may not be coming down anytime soon, or at least going further up, I should say. But then there's the monetary inflation that is huge to both brand new retirees as well as people who have been retired for a while and on the older side.
Yeah, exactly. And you want to protect your portfolio from those things. Now,
Yeah.
We talk all the time about investing by contract and protecting your principal.
Right.
We talked about increasing income. We talked about protecting principal. And there's not a lot of people that spend all their time, a lot of professional advisors that spend all their time thinking about how to protect principal while beating and play by increasing retirees' spending power, right? And so you just gave a pretty cool example of somebody who actually beat the market. They beat the long treasury bond. They beat the S&P. They beat the NASDAQ over the last 2 years, and they beat inflation. Raise your hand if you've done that.
I guess another question would be, raise your hand if you know that you've done that.
Yeah. And they had an actual positive return over the last 2 years, because from today where we're talking, the NASDAQ, the S&P, and the long bond, none of them had positive returns, while long bond being actually the worst out of all of them.
Yeah.
By a significant margin. So actually having a positive return plus the income. So we don't believe in looking at that CPI, right? We believe in getting people enough increase in their income where they actually can buy groceries. Right. And to clarify stuff a little bit, that may or may not be past where we see those pricing going up, because we have all these things putting us to the point where it's looking like that price inflation is pretty much tapped out. This is without things like a recession, right? Last year, everyone was predicting recession. This year, no one's predicting recession. And none of the leading indicators have changed. They've gotten worse for a potential recession. But you look at the Wall Street firms, you look at the forecasters, and they got rid of the recession. And we were 99% certain a year ago, and it didn't happen. And so people are giving up on it. If we went into recession, if we go into recession, what's that going to do to prices? It's going to bring them down even more. Now we're talking even more disinflation, right? Or deflation.
Yeah.
But when we have a recession, that's when we turn on money printers. That's when you want to start protecting yourself from that monetary inflation, right? And that's what we want to get into, I think, a little bit next in the second half, is talking about how you can protect yourself. Because folks, the answer is not stocks. I know when we had price inflation, the answer was buy stocks, and now monetary inflation, which people aren't talking about yet, but that's what's going to be the next, I think the next couple of years. Yeah. And everyone's answer is just stocks. There's better ways. Just like your stocks didn't give you a 50% increase in income over the last 2 years, I don't think that they're going to protect you as good as other things for the monetary inflation that we may see.
Well, stocks are easy, right? Wall Street's whole answer is have as much money have as much of your money in the stock market for as long as possible, because they make money if the market goes up, if it goes down, if it goes sideways. But you only make money if the market goes up. And the market has not increased over the past 2 years. It's gone down, it's come back up, but it's not even back up to where it was. But so that's not the answer, but Wall Street won't tell you that, because people don't know what people don't know. And you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know, but not when they listen to us. They're going to know what they don't know. So today's topic is inflation. What's your strategy? And we love that. Before we go to break, we love to give you this book by our friend Anthony Isacaro. More Life Than Money, How Not to Outlive Your Savings. That's one of retirees' greatest fear, is outliving their money. And Anthony goes through a lot of different things that will help you to know what you don't know. And love to put this book in your hand. Put it, best-selling Amazon book, for free for the next 5 callers at 800-725-7616. 800-725-7616. There are operators waiting to receive your call to the next first time 5 callers. 800-725-7616. Call them now.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
As we were growing up, little adventurous kids. I have a bunch of brothers and sisters and some cousins, and we went to this program called Royal Rangers. And they would teach us how to do things like use compasses, hiking, camping, a lot of cool adventures. Learn some different things about helicopters or Marines, or how to tie knots, or all these kinds of things, life skills that people need to know. And one of their motto is ready. A Royal Ranger is ready for anything, right? And as we think about our clients, and we think about our clients' assets, we want to be ready for anything. We want to be protected from downside tail risk, but we also want to watch out for upside tail risk. There's a lot of risks people don't even think about. And our model, our goal is to be ready for whatever happens. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Today's topic is inflation. What's your strategy? And, Daniel, that's great tie-in to what you're doing, because, I believe as Boy Scouts they hope for the best, but plan for the worst, right? And that's a great way to do that, to be ready. And too many times I see people who hope for the best and plan for the best. And that is not a good retirement strategy. Hope, let's hope, but hope is not a retirement plan, right? Guarantees and promises are a retirement plan. And when it comes to inflation, we need to know how to be able to protect ourselves in regard to these two different kinds of inflation: price inflation, monetary inflation. Price inflation is prices going up because of the not enough supply, more demand, price go up. Prices are typically do not come down, but what they can purchase, what you can get for that price is better. Like, for instance, today, a computer, what you can get for $2,000 today is phenomenal compared to a computer, 40 years ago that you paid $2,000 for. And so that's the idea there. Then there's the monetary inflation, which is increase in the money supply, where the government's printing money. And depending what they do with that money, if they give it to people the way that they did after COVID, or if they just use it to it makes more stable the infrastructure on the back end of things, like they did in 2010 and through 14 and that kind of thing with quantitative easing and so forth. But that's kind of what we're talking about today: inflation and how to protect yourself. That is the key. Daniel, how do we protect ourselves?
Well, that monetary inflation is like, you think about a patient on life support, right? It's supposed to be all the machines holding them on life support. And then they start healing and they start recovering. And the patient is the economy, right? And eventually that patient needs to come off that life support, because they're not going to last forever, right? They're not going to make it if they have to stay. They're not going to have a real life if they have to stay on that life support, right?
Right.
And that monetary inflation is those machines holding that patient, keeping that patient alive. And eventually the economy needs to come off the life support. The difficulty is it's still kind of on the life support from 2008. And that's what Chair Powell is trying to get us off of. And that's the whole rate thing and everything. But like, there's still stuff going on in the background that they say they're removing the stimulus from the economy, but they're turning other things on. Like, we were going to get away from it, and then Silicon Valley Bank fell apart. And so they opened up this new program where banks could borrow, and it doesn't come off. It doesn't come off. And so how are you going to protect yourself from that?
Exactly.
AAA, it is right around Thanksgiving. I'm not sure when this is playing, if we're before Thanksgiving or after Thanksgiving, but we're right around Thanksgiving. And we are grateful, right? We are grateful for our clients. You have a whole thing about fiduciaries and watching out for our clients. And clients, we don't have stockholders. We don't have to obey a board. We don't have to do what's in the best interest of stockholders. Our stockholders are our clients. The only person that we have to obey regulators, but the person we answer to is our clients. Do you want to talk about that a little bit, how grateful we are for them, and how I know it's off subject, but this just came to mind right around Thanksgiving, how we are so grateful for them, and why we do what we do, being able to increase over the last 2 years their income by 50%. Our income portfolio is up by 50%. The income on our income portfolio is up by 50% over the last 2 years. 25% annualized is for them, right? Because we care about them.
Right. Exactly. And, like Daniel says, fiduciary, the word gets kicked around a lot. Fiduciary is somebody that has to work in their client's best interest, but there are many people out there who are fiduciaries, but they're first and foremost a fiduciary for the stockholders of the company, secondarily for the account holders of those big name companies. And, there's a lot of things, and there are fiduciaries that won't put it in writing. If they don't put it in writing, that's not any good, right? But the whole thing with us is that we work for our clients, and we are grateful for our clients, because there is no us without you. If you're our clients listening to this, thank you, right? The letter U in us, there is no us without you. Right. And that means you as our clients. And we are grateful for the decades of your trust, your confidence that you put in us to be able to help us. And we are not the same company we were 30 years ago. We're not the same company we were 20 years ago or 10 years ago or 5 years ago, or even last year. We're different. We're growing. We're learning how to do things better for our clients all along to be able to do and get this exponential growth and compounding for our clients. So we are grateful to you and are so glad to be able to be here. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is inflation. What's your strategy? Because people don't know what people don't know. We're putting together and helping people understand how to be able to stay ahead of inflation. And in that, we want to stay ahead of taxation too, right? So we've got a paper that we'd love to put in your hands today to educate you further. It's only about 3 pages or so that we put together, called 7 Risks to Your Retirement. One of those risks is inflation, but then there's 6 other risks, significant risk to people's retirement. If you're in or close to retirement, this will be beneficial to you. You can have the paper for free by calling us at 800-725-7616. 800-725-7616. You can contact us on the web through agemy.com, agemy.com, the 2 words AGEMY. And then there's also the ability to look at our other podcasts and other educational materials that we have there for you as well. Today's topic, inflation. What's your strategy?
So when we are talking about the monetary inflation, sorry to get off topic there a little bit, but I thought that was important.
All good. It's all good.
I feel very blessed that we get to work with such wonderful people. And that's why we work so hard, right? At these kinds of things, kind of keep them ahead of these things.
Well, we have to answer to God too, not just them. So that's I want to be able to sleep at night, and I can't sleep if God's keeping me awake. So,
yeah. So we talk about income and we talk about compounding income, right? Income, compounding interest is the eighth wonder of the world, right? It's a magnificent, magical thing. And that is one way to keep up with inflation. And that is exactly how we've been able to get those income return, those income increases, is through diligence over years, and then it explodes. And having a portfolio set up right that takes advantage. We have a lot of things in the portfolios that benefited from raising rates. So it'd be like, think about if you had a adjustable mortgage. The bank doesn't care if rates go up. Actually, they hope rates go up because you're going to have to pay them more money. But you don't want to be the person holding that when rates are going up, because now your rate went from 1% to 10%, right?
Yeah.
You can't afford your mortgage anymore, right? Yeah. But if you own that in your portfolio, you're pretty happy because now your income just went up. And these are part of the reasons how we were able to do so well on income from having these types of things.
Right.
Now we're talking about what happens with monetary inflation, because the patient's still on life support.
Right.
Right. And market cycles have typically time frames behind them. And there's been plenty of times in history where people predicted there will never be recession again. There will never be that we've beaten the economic cycle. And some people say we already went through the recession. Some people say there's going to be one. So we're talking about monetary inflation because the patient's still on life support without even going into a recession.
Mm-hmm.
If we go into there's going to be even more monetary inflation. So how do we protect ourselves from that? Right? That's what that's what we keep holding people on the edge of their seat to hear. How do we do that?
Exactly.
If we look at the charts, if we look at what has been some of the best inflation or monetary inflation hedges, things like gold come to mind. And people might be like, that old relic, that shiny rock, that pet rock, right? That's a joke. And we can look at a 100-year chart and we can see how that has protected people from these kinds of things. It does nothing or it goes down and then it explodes higher. And then it does nothing for periods times or it goes down and then it explodes higher. It's got a very repeatable, it's got a very predictable, repeatable chart.
Yeah. Right.
And it's explosive when it does move. It's not like 7%, right? This is multiples that it does. For those people who are like, haha, gold, that pet rock, there's another newer technology that has done even better. Now, it doesn't have the same track record, but it has done even better. And that is Bitcoin, right?
Right.
And when we look at monetary inflation, we can measure gold to it, and we can look at 1 unit increase in monetary inflation. Gold typically has 1 unit increase.
Okay.
And if we look at the 1 unit of increase in monetary inflation and we compare that to Bitcoin, it usually has a 5-point increase. And so these are two ways. We can dive in a little bit more into this after the break, but these are two really cool ways. And there's another way that you can use the gold, but get even a leverage on that for those people who are like, I don't like that weird digital currency thing that drug dealers use, right? You can, there's a cool way that we've been using for a while with gold that really can protect people from that.
Nice. All right. Well, we need to take a break and appreciate that, Daniel. We're looking forward to coming back and hearing more about that. But in the meantime, we have this book we'd love to give out, More Life Than Money by friend Anthony Sicaro, CHFC Esquire. And Anthony's done a great job putting together a book that can educate you on the various things that you don't know about, that you need to know about if you're in or if you're close to retirement. This will help you to be able to stay ahead of your knowledge bank, to be able to prepare for retirement or live in retirement. We'd love to put this in your hand for free. 800-725-7616, 800-725-7616 to the next 5 callers, first-time callers at 800-725-7616. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
So AAA, I'm somebody interested in keeping up with inflation. I'm somebody interested in keeping up with monetary inflation. So I come to you and I say, this looks like a promising young man. Okay. Back when you're 18 years old, this guy looks like he's going to do well. So I say to you, Andrew, I would like to pay for your college education. And you say, okay, why do you want to do that? I say, well, I'll pay for your college education, and all I want in return is 1% of your future earnings.
Okay.
You say, okay, I'll take that. I'll take that. Free education, and I just got to give you 1% of what I make. Today, all these years later, did I make money on my investment into your college education?
You sure did. Making multiples.
I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We're glad that you joined us here. Today's topic is inflation. What's your strategy? And we need to be able to stay ahead of inflation. We talked about how the two different kinds of inflation: price inflation, where prices are going up, and then there's monetary inflation, where there's more money being put into the system, more money being printed by the U.S. government, that kind of thing. And how do you protect yourself against inflation? And the typical answer is, well, buy stocks. And that's not the answer. That might be an answer. That's hoping for it. That's the answer, but there's better answers than that. And Daniel, this one that you just came up with, sounds real good to me. So you talked about, as we finished up the last segment, about how gold is a way that can protect us against inflation, but a gold is a 1-for-1 increase kind of thing. As things go up, gold will continue to go up with that. Well, so that's good. Then you talked about digital currency, specifically Bitcoin, and how it's a 1-for-5. So, if it goes up, it's a multiple of 5 for everything it goes up, which is really good, right? But people may not like that. And I think that this one that you just talked about is somewhere in between. Am I right?
Yeah. Exactly. So, a lot of people are going to think that we're talking about, miners, gold miners, silver miners, precious metal miners, because they have leverage on the gold price.
Okay.
The difficulty is their expenses go up with inflation, right? Mm-hmm. So when we look at the gold price, it's crazy what it does, right? So like it will shoot up when there is a huge monetary pulse. It's like holding a ball underwater.
Yeah.
And then all of a sudden it shoots up. It doesn't go. So like from the year 2000, I think it went back down to kind of the previous high, or the previous cycle high. So it went down to like $400, right? Wow. And then 2011, it hit 2000. That's pretty good returns, right?
Yeah.
And then now it's about 2000 again. So it's done nothing.
But it went back down.
Yeah, it went down. Right, exactly. So it goes down, and it's like that ball in the rudder is good. And that doesn't mean tomorrow it's going to do that. But we read the tea leaves. We look at all the things around the world. We see that central banks are accumulating gold like they've never done before, or at least in modern history.
Okay.
We can look at liquidity flows. That's why we're talking about this monetary inflation now, because we can see what countries are doing to stimulate their economies, to get their economies kickstarted again. And we can see into the future what's going to be happening with these kinds of things. We don't know what will happen tomorrow. We don't know what's going to happen next year. But just like we didn't know for sure when rates were going up, we positioned ourselves so that if rates went up, we would be okay. We would be better than okay, right?
Mm-hmm.
So if we are getting ready for this spring, for this beach ball to shoot out of the water, right? You could own gold and you could do better than the 7% return, or the average monetary inflation that's been happening, because it's getting ready for that coil that it typically has.
Yeah.
But the thing that we're talking about here with these royalty and streaming companies, what they do is you make that one-time purchase. So the company makes that one-time purchase, just like in our example, I bought your college education for 1% of your future.
One time.
Now your income is increasing from all different ways, right?
Yeah.
It increased one because incomes have just gone up from when you went to school until today. So there's one thing that just happened because of monetary inflation.
Yeah.
So even if you weren't, even if you weren't a financial success, people would have done well just because if incomes went up.
Right.
Another is because you have multiple businesses. So you're getting from all those different things. When you went to school, you didn't know you were going to own multiple businesses.
Nope.
You have different assets. You have retirement accounts. You have buildings. You have houses. We have these kinds of things. And these went up in value. So that 1% is of all those types of things. So now we flip that over to these royalty and streaming companies. They do the same thing. They invest in an asset, in a mine, in a pharmaceutical, in a drug. It's all kinds of stuff. It's not just, but it's a one-time expense. It's not a miner where they have to buy dump trucks and they have to buy fuel and they have to buy more land. It's one time. And if the mine expands, their 1% goes up, or 1.5% or 2%, whatever they work out that deal to be. If the price goes up, their 1% goes up, right? So they put it in all these different things, and it could be land, it could be water rights, it could be grazing rights, it could be oil rights, it could be gold, it could be silver, it could be pharmaceutical, it could be all these different types of things. But the point is, it is the probably best inflation hedge. And so now you get more than that 1-for-1 on gold. You might get a 2-for-1 or a 3-for-1 or a 4-for-1 without taking on any kind of crazy risk.
Cool. Very cool. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is inflation. What's your strategy? And Daniel's been talking about different ways that people can protect themselves from inflation, one being gold, and another being my streaming companies, and another being Bitcoin and digital currency. And so there's lots of other ways other than the stock market, because the stock market tends to be just hope, and hope is not a retirement plan. Today we have a brochure we'd like to give to you to be able to help educate you further on risk in retirement. If you've never retired before, you don't know what the risks are probably, whereas we retire every day vicariously through our clients. So we know, we've been there before, and we'd like to give you this paper to educate you on that. One of those risk of retirement is inflation, but there's 6 others that are significant that you need to be aware of, need to get help with. And that's what our clients are getting: help with inflation protection, help with these various risks that are associated with retirement. You can have this paper for free by calling us at 800-725-7616. Call for your free copy now. Daniel, this is exciting stuff, man, how people are able to multiply, stay up with, right? When we're talking about gold going like a 1-for-1 as time goes on, we're talking about these streaming companies going for maybe 2-for-1, 3-for-1, 4-for-1 as time goes. Bitcoin, digital currency doing maybe 5-for-1 as time goes on. And that's not what the stock market is doing, right? Nowhere in that kind of vicinity. My take on the stock market is, in a best case scenario, it might be like 1-for-1.
Yeah.
In a best case.
Best case, that's kind of right where it is. If you invert the balance sheet with the S&P, it's kind of right around that spot. But the difference with the gold is you don't have that same type of kind of volatility.
Yeah.
And with these other things, you have more volatility. But that's where we get into position sizing. So we want that robust portfolio. So you still want that income portfolio. You still want to invest by contract, where it's not investing by
the
hope.
Basis, the foundation.
You're getting return on principal. You know that you are going to be collecting this steady stream of income. And it allows you to take advantages of situations because it's this cash machine, right? And So if you're compounding that way, then you are growing the portfolio organically. And you're allowing yourself to increase your spending power. So that takes care of the one side. That takes care of the price inflation. But then what we're saying is you can mix some of these other things into the portfolio. So you have the explosive, exactly. And it can protect you on the tail risk of a melt up, of monetary inflation going crazy, right?
Yeah.
And so you still have less volatility than just regular markets, but you have a bigger upside.
Yeah.
Because you have these explosive kind of things in there too. And you don't have to worry because you just sit back and collect your paycheck.
I like that.
Paycheck.
You mean I don't have to work for my paycheck? Nice.
Yeah.
You mean my money's out so hard at work that it's sweating in the sweatshop and I don't have to do it. That's a beautiful thing about true diversification, right? Because, too many times people in the financial world talk about diversification, but it's like, stock, so much in stock mutual funds, so much in small cap mutual funds, so much in bond mutual funds, so much in specialty mutual funds, so much in, real estate mutual funds, but it's all mutual funds. It's all the stock market. And the problem with that is when the tide goes out, all the ships go down. So if the market goes down, everything goes down. And the whole thing about investing is that, when something's down, something else is up and vice versa, so that you can take advantage of what's going on. So this is true diversification. All these things you just mentioned, the gold, the digital currency, the stream income, they're all different types of investments. They're not the stock market. They're not in going along with that. So plus, if you add in these contracts that you're talking about, you're talking about turbocharging somebody's retirement portfolio, where most professional financial people, their answer is stocks and stock funds.
And the difference between each of these is the client, the retiree, right? People have different risk tolerance, different goals, different purposes for their money. So we're giving some different examples, but this is not cookie cutter. This is not recommendations. This is purpose built for the person that we're talking to, the person that's sitting down in the chair that we're talking about their individual retirement, right? Yeah. And so different people like different things. The people who did chose Bitcoin this year have done very, very, very good, right? The people who chose gold over the past, 3, 4, 5 years, it kept their portfolio very steady, right? Yeah. Not a lot of ups and downs. It's been very steady. So it just depends on the individual, the retiree, and what their goals, hopes, dreams are.
How is Agemy Financial Strategies like Burger King? We like you to have it your way. All right. So you've been listening to Financial Strategies with Andrew Daniel Agemy. Today's topic is inflation. What's your strategy? People don't know what people don't know. So, we're trying to educate you and give you information that you're not going to find elsewhere. Today, we got this book by our friend Anthony Siccaro, More Life Than Money. It's yours for free. It's a best-selling book on Amazon. Yours for free by calling us at 800-725-7616. No obligation. 800-725-7616 to the next first time 5 callers. You're welcome to get this book to educate yourself, to help you know more. And if you have questions, please email us, contact us on our website, office at our website, which is agemy.com, agemy.com. We love to field your questions, ask them on the air, or talk with you specifically about that. Up to you. 800-725-7616. And we, educated retiree is a happy and stress-free retiree.